what just happened? Where are you? You're right there. Hi, Cheryl. I thought I was by myself for a minute.
Hi.
Hi, are any of y'all actually in the Mount Pleasant office?
No, I'm at home.
Oh, okay. I was just gonna maybe go and check on Anton.
Yeah, I can text him.
I'm in the Mount Pleasant office and he's not in his office. I'm next door.
Oh, okay.
You know what? I'll text him.
I think maybe that'd be great.
Okay. Okay. I just texted him. He usually texts pretty quickly.
Thank you.
You're welcome. Yep, he said there's a tech issue on his end.
I figured it was something.
Always tech, right?
Hi,
Hi.
sorry, I got a new computer and all of a sudden it was saying, hey, I sent you a new code to this Keller Williams email, which I don't have access to. So I had to find my old computer, boot it up. So hang on a second.
All good, all good.
I'm just gonna. I'm still here.
Okay, so it's for Zoom.
Yes,
Okay, so it's 2000049.
thank you. Bye. Bye. Okay, sorry, almost there. All right, how's everybody doing today? Can you see my MLS screen? Okay, there
Yep,
we go. Sorry, that's what I get for getting a new computer and not having everything loaded. So, all right, I'm gonna just pulling up here. So what I was gonna do is go through, kind of the overall stats today on Market Monitor. Hope everybody had a good July 4th and July 4th week.
we did.
That's good. And all right, finally loading up here. So, Market Monitor. All right, here's our favorite Market Monitor. So what I've been watching, has everybody seen the inventory going up?
Yes.
Not necessarily a bad thing, just kind of readjustment again. We were on a downward trend for 2 years, and now here we go on that upward trend. So I'm just on Market Monitor and just going to go through some general stuff that I usually go through, but then I'm going to go some different details. So here's the median sales price. So we're up 18.3% year over year. But look at from May to June is actually down a little bit, which is not that unusual to have kind of some upward downward movement. But this is something to watch because this has got to be slowing down at some point with the higher interest rates. 18.3% is not going to be this pace next year. So one way to look at this is that if we go to the rolling 12 months, so it's 16.5 over the past 12 months, but last month, if you look at it, it was 18.3. But watch this trend start to level out, especially the second half of the year. It's still going to be higher, but it's going to go down from where we're at here. Price per square foot, the same thing, but you also notice that downward trend from May to June. So 15.7% on price per square foot. A percent of original list price. Now we're still over at 100 for median. So remember, median is half the houses are selling for 100% or higher, and half are below that. But look at the average. So the average last month dropped from 101.2 to 100.5. Now that's still amazing. We're still over 100%, right? But we're also seeing that change start to happen. Now we saw that last year too. So last year from June to July, so June was the peak. This year looks like May's the peak, but that's a pretty big reduction in 1 month. And I expect we're going to see this trend continue. I mean, we got down to, on average, 98.8, I think was the low in the winter months, if you want to call it that. So we're probably headed down that direction, if not more. So, you know, the buyers are gaining a little bit of leverage, not completely, but they're gaining a little bit. Days on market. So here's the median. So we're at 4. Now, again, we've pretty much been at 4 or lower since March of 2021. Now, if I were to bet, by the time we hit this fall winter, we're going to be higher than we have been in a couple years. So we're going to be going back up at the rest of the year. So look at the average. So the average is down to 14, which is lower than a year ago. But again, I think these are going to be the lows that we're going to see, and it will be an upward trend from here. The months of supply. So on the monthly basis, so we're 1.2, which again, still a seller's market, but it's also changing. It's the highest. So you see, we were 1.2 last summer. We got down to 0.7 in the spring, up to 1.2. We haven't been above 1.2 since basically 2020, right? So watch the next few months. We're going to go above, you know, we're going to be looking back almost a couple years of, you know, since it'll be 2020 since we've been this high on months of supply. And again, still a seller's market, but it's changing. Homes for sale. Now, I still don't quite understand where Market Monitor is pulling their numbers from. So just kind of look at it as an annual change. You know, it's hard to tell exactly where they're pulling their numbers from. But when I looked at my calendar, I write down every morning between 9 and 10, the number, we're 45% higher than we were last year. So from 1 year ago, we have 45% more for sale. Now from a couple, 3-4 months ago in the middle of March, we only had 900 for sale. So 2,400 seems like a lot of choices, right? It's all relative. From 60, 90 days ago, it feels like we have a lot of options. Now the 2,400 or so, I saw a 2,400 number. From that point, we haven't been that high since 2020. Right, so we started January of 2021 on my calendar. We started at 2,337. So that was the highest number for 2021. So we're above the highest number we've had in 2022 and above 2021. So we're looking back to 2020 for a higher inventory than we have right now. So, you know, we're past that low in inventory for sure. And the question is, how high do we, you know, how quickly do we go higher? Now we still got to get back up to, in this range here where we're at 19, you know, the 62, 6,300 listings. So 2,400 to here is still a long ways off, but it's coming, you know, we're plussing up 100, 150 week, you know, per week. So it's happening a little bit quicker than maybe what people expected, but also 5 to 6% interest rates have that effect. So, you know, that's all happening at the same time. So closed sales. So look at the closed sales off 18.6%. So now keep in mind, that's June of 2022, we had 2024 close, and June of 2021, we had 2486. So you can see the two highs. Look at July of 2020 and June of 2021 were about the same. So over 2,400, between 24 and 2,500. Well, we closed 18.6% less this June than last June. So that's kind of a reflection on a couple things. One is the change in the market of affordability, and that's a combination of prices and interest rates. But it's also, to some degree, a lack of supply. You know, you have to have a seller to have a transaction, and we kind of ran out of sellers for a period of time. So, you know, 18.6 is a fairly significant reduction from a year ago. New listings, fairly flat. I mean, 2,554 is, you know, about where we were last June. You know, so fairly flat. But if you, I think we've talked about this before, you don't even really notice the COVID impact on new listings. It all looks the same, right? It's the same level as we've been for years. So pending sales. So we're off 8.2% on pending sales. So now pending sales, what does that reflect? That's the next few months of closings, right? So we expect those to be lower as well. And even the pending sales, so we peaked out in March of this year in pending sales at 2032. We peaked out last year at 2367 and the year before at 2352. So these 2 years were greater peaks than this year. So what does that mean on the bottom, right? Because these bottoms were about the same, 1523 and 1534. Well, that would tell me we're probably going to be, if our peak was lower, our low is probably going to be lower, right? So we're probably going to go below this 1500 mark. And if you look at the end of 19, we got down to 1,072 pending sales in December. So do we get that low? Maybe not, in my opinion, maybe not quite that low, but we're going to be down in this range here. We're going to be below the 1500. So watch this closely because that's reflecting what's going to come up, because remember the December pendings are generally your January and February closings. So that's going to have a huge impact on the 2023 numbers, and our 2023 numbers compared to the spring of 2022 are not going to look great as a year-over-year increase or decrease, right? Because I mean, we had, you know, a pretty phenomenal run a couple of years here. So, you know, just watch that closely. Dollar volume, you know, we're still clipping over that $1 billion mark in the spring and summer. And one thing that I like to look at is look at your rolling 12 months. So here's your rolling 12 months. So June, we're just under 12 billion. So that's the past 12 months as of June. So it's very easy math. We were closing about $1 billion a month over the past 12 months. Well, you know, look at this rise from basically May of 2020 to June of 2021, right? That is a massive change from 6.8 billion to 11.4 billion. So 11.4 billion in a year plus to 11.9, that's decent, right? I'm not saying that's a bad increase, but that's about 4 or 5%. That's fairly normal. This was the massive growth right in here. So now we're kind of going along at a clip, but also look at May to June. That's actually a decrease, right? So we closed rolling 12 months over 12 billion to under 12 billion. So watch this number, it might sag a little bit. It's not going to drop back to where we were here. But this number, dollar volume, that's how we get paid, right? So that's a big deal. So that's starting to fall off a little bit. So watch that closely. And when I go back to closed sales, I wanted to show you when you do the rolling 12 months. So look at that growth, the same thing, right? From May of 2020 to June of 2021 was the massive growth. We were closing 25,000 in a 12-month period in June of 2021, whereas we're only at 22, right at 23,000. So we've lost a net of 2,000 sales in the past 12 months. But look at this drop the last month, right? That's a pretty significant drop here on a rolling 12-month average. So we just got to watch this closely because we very well could be going back down to the level pre-COVID, which was between 18 and 19,000. So, you know, the closed sales, and that's driven by lack of supply and affordability, the same problems, right? The house price has gone up a lot, interest rates have gone up a lot. There's still not that much, relatively speaking, to choose from. So all that reflects in your closed sales. So this is a number to watch closely as especially this last month, that's a pretty significant drop off in the closings. The dollar volume, look at shows to pending. So this is, let me get rid of the rolling 12 months. So this was interesting here. So we were at shows to pending, the median was about 13 in February, right? You don't think like, well, February's not spring, summer, right? Well, it was actually busier in February than it is today. So we've gone from 13 shows pending. So this is, again, this is data from showing time, right? So new construction builders that have a site sales office, that's not part of this. If agents are having them call them directly for that, this is strictly showing time, but it's a good reflection of the market. So we were doing 13 showings to pending in February and we're down to 8. So what, in my opinion, what this is representing is that, yes, there are less buyers out there, but also the sellers, I think, are a little bit quicker to not wait through the weekend and gather showings because they know that first offer might be the best one, right? So we're not getting houses with 26 offers that they have 50 showings on. It's skewing this number. So right now what's happening is that the sellers they have more limitations on how many offers are coming in. And again, the first one they might try to negotiate and work out a deal with. If I go back, I think showing time started right around 2012. So kind of ignore, this is where it started. So kind of ignore this, but look at the 8. The 8 is the lowest we've been. Again, ignoring this first part, that's the lowest we've ever been. So again, that's a drop off in showing activities and the sellers reacting quickly, but also at the same time, the buyers realizing that maybe they've still missed out on houses, and before interest rates go up higher, they're still reacting quickly. So you have a combination of buyers reacting quickly and the sellers not really waiting through the weekend anymore if they have an offer that they find to be acceptable, because you can't necessarily count on multiple offers at this point. Here's the average as well. So the average went from 17 showings down to 11. And again, look at the 11, that's the lowest it's been. So both those numbers reflect a big drop off in the showing activity in that same time period, February to June. And look at your showings per listing. So this is, again, we hit 11.2 showings per listing, and this is per month, I believe is what they should put that in here. This showings per listing per month. So 11.2, we're down to 6.4. So that's almost half. So we have half the traffic happening now that we did in February. But look at February, look at how much higher that was historically than any other month. You know, we would peak out at, 5.5 to 6. So we were double our traditional peak. What are we doing? We're probably going back down to what should be traditional, right? In the spring and summer, you're hitting, and again, this is showing per listing, so per month. So you might be getting 1 to 2 showings a week, right? So now agents freak out when they get 1 to 2 showings a week, but it's like, well, that's kind of the way the market normally works. So again, it's that adjustment from an all-time peak back down to what we should be in a normal market. So we're still, think about it, 6.4 is still above any of the other peaks, but it doesn't feel like it compared to February. So that's something to watch there, as well as these showings. And again, you can see that seasonality. That seasonality will drop off once you go to the winter. So it's not going to all of a sudden jump back up to 11 in the fall, or headed back down to probably a more normal cycle like what you were seeing in here. And if you break down some of these other areas, so if we go, I was looking at, so watch this, if we do, I'm just going to pick up Mount Pleasant right now. So this is area 41 and 42. So if I look at Mount Pleasant, let's look at the same thing. Look at the, and let me zoom in a little bit. Look at the median price in Mount Pleasant year over year. That's not a typo, that's 39.2%. So the median price sale in June was 821,500. Now, I feel, and look, in May it was 701. I feel like this is an anomaly. I think that's too big of a jump in 1 month. I think there must have been just a whole bunch of high-end sales, and it just all happened to close in June. So don't be surprised if we return down to this level by next month or the following month. I think this is, that 39.2% is a massive jump. And I think that's a 1 month anomaly. So maybe don't be throwing around that number too much until we get a couple more months of it. A better way to look at that is, so 21.5%, okay, I believe that. I don't necessarily believe 39.5%, but 21.5. And what I did is I just did a rolling 12 months. So over the past 12 months, the median price has been 650. That's not what it is today, But the growth of 21.5, I tend to believe that's probably a more accurate number than using this one crazy month that jumped that. I mean, to go up $120,000 in 1 month, there's some data points in here. There was probably the number of sales, and you'll see when we go through Mount Pleasant, the number of sales is off. So you get a few really high-end ones, you know, it can really skew this number. So price per square foot, 35.5%. So again, that's a huge jump from year over year. Percent of original list. Now this is interesting. So we were at 102.5. Now this is the average. We're at 102.5 in April. We're down to 100.7. Again, you'll see that typical trend up and then trend back down. The median, the median price in Mount Pleasant was over 101 in April. We're back down to 100. I wouldn't be surprised we start to see that in the fall and winter fall below 100. So those trends are changing. Days on market, the average is 8, median is 3. So again, still a very active market, but watch this. I mean, we're definitely have formed the bottom and going to be coming up at some point from here. Months of supply. So in January, we're 0.4 months of supply. February, 0.4. We're at 1.2. So 1.2, still a seller's market, but not 0.4, right? We are 3 times slower in theory than we were in January or February. So things are changing. And if you go back in time, let's look at the last time we had 1.2. You know, you have to go back to 2020. So November 2020 was the last time we were this high. And again, to go from 0.4 to 1.2, which way is this headed? It's headed higher, right? I mean, this isn't all of a sudden going to start going back down. You know, it's headed higher. So we're going to return to that normal 4 to 5 months of supply. It's just how quick we get there. Look at the homes for sale. So we're 44% higher June of this year. So we have 255. So 255, June of last year, we're 177, right? So that's a pretty significant increase year over year. And when you look at the market as a whole, if you look at all of Charleston MLS, we have about 45% more for sale today than we did 1 year ago. So Mount Pleasant looks similar in numbers to the market as a whole. Now, we had, 800, 900 to 1,000 back in 2019. There's not a ton of new construction. That's a big number to achieve. I think we'll probably see in that, 600 range to 800 range. 1,000, I don't know where those are going to come from, but we'll see what happens in the future. But watch the homes for sale, closed sales. So look at this, off 23.2% in a year. So we closed 262 in June. Last June, we were at 341. Because remember, June is typically the highest closing month. Well, here's our high, more than likely is going to be this 262. Well, where are we going to go from there? Well, if we go back in time, here's your 10-year outlook. We actually were selling more in Mount Pleasant in 17, 16, 15. Look, all those peaks were higher than this peak. So, those lows are going to come in probably around where these are, or if not lower. So our peak was even lower than 19, right? And it's based off, we don't have anything to sell, right? That's kind of, it's affordability and nothing for sale. And that's what's driving this peak to be here instead of where it's been the last couple of years. New listings in Mount Pleasant, look at how much lower, we hit 315, 320 last year. So we had 331 in June of this year. That's actually an increase. So we had a decrease in closings by 23% and an increase in new listings by 4.4. That's why your months of supply is changing so quickly. But you can see the typical peaks and valleys in the Mount Pleasant market on timing of listing. We're going into that time of year where less people typically list in the month, right? The second half of the year looks different than the first half. First half is always increasing, second half is always decreasing. First half is increasing, it's going to decrease. Pending sales off 16.5%. So again, this is just Mount Pleasant. Must be a lot of numbers to crunch. Still thinking about it. So pending sales are off. Walk up off 16.5%. But look at that pending sale peak, right? We hit 246 in April. We were at 368 in the middle of 2020. 2021, we hit 322. So our peak is way below. I mean, you have to go back to 2014, right? You have to go back. So in Mount Pleasant, if that's where a big part of your business is, you have to go back to 2014 to have an equivalent peak in the number of number of pending sales. So that was a different market. So we're peaking at a lot lower number than we typically have been the past few years. Dollar volume. So this is why you're seeing that median sales price be so high. The dollar volume is still setting records with not as many closings. So that's why you're seeing that big jump in the sales price. Shows to pending. So we went from 20 in January to 11. So we're almost cut in half on the shows pending. Now, again, shows pending still means it's going under contract. You're just not getting the 20 showings, you're getting half of that. And this is, this is the average. The median went from 16 to 7. So we've lost more than half, the showings in Mount Pleasant. Shows per listing, we went from 14 to 6. Again, we've lost more than half. So the showings are way off, but again, relative perspective, still more than we were traditionally this time of year. So yeah.
On the shows to pending, any idea how much that impact is felt by people going straight to contract?
Well, and I think what's happening, that's exactly what's happening is that, I would say kind of my strategy has changed a little bit. It's like, in February or March, when you had 20 showings lined up, you're like, okay, let's put a Monday deadline on the offers.
Yeah.
Now, when you have 7 or 8 showings and you get 5 no's and you get this one really good offer, what are you doing? You're talking to yourself. It's like, look, you got 5 people who said no thanks.
Right.
We're waiting to hear from a couple others who are scratching their head thinking about it. And we got this one really good offer. What would you do?
Yeah.
Right?
It's
So
interesting to know that it was just as hot 2 years ago, early 20 in Mount Pleasant, right?
Yeah. So I think what's happening is that we're getting that one good clean offer relatively quickly, and we're taking it and cutting off the showings.
Yeah. Thanks.
I think that's exactly. I think that applies to more than Mount Pleasant. I think that's happening across the board. So, it's interesting conversations because of this change, depending if you're dealing with a seller or a buyer. The buyer, when you look at the homes for sale, it's like, great, we got more choices, right? And you might be the only one making an offer, or maybe you only have 1 or 2 to compete with, not 10 or 12. So it's your conversations are changing as this market changes, and they should be. If your seller has a very acceptable offer in front of them and there's nothing else coming behind it, then there's probably nothing else coming behind it the next week. The buyers are still reacting quickly that are ready to go. But you're going to see all these trends continue to head that direction. You look at, let's look at an area. So if you look at below the crosstown, so here's below the crosstown. Now, again, keep in mind when you don't have a ton of closed, because on a closed sales perspective, 54, that's a lot different than the 2,000 of the market as a whole. So the numbers can jump around pretty significantly when you don't have a lot of sales. So if you're going to a smaller area, I definitely recommend get rid of the house prices I'm just going to give you an example. The house prices in Charleston, south of Crosstown, didn't go from 1.372 the next month to 454, right? It's just there's not many sales. So when you get an area like this, to get rid of some of this, go to rolling 12 months. that's kind of a more accurate representation to me of where the market's trending. And you know, south of the crosstown was 8.1%. So not like the market as a whole, and not like Mount Pleasant, you know, even doing the rolling 12 months growth, but not double-digit growth. So if we look at price per square foot, you know, that is a bigger reflection of the double-digit growth. So I think those are the renovations that are happening, people putting more money, because you can change your price per square foot, not just because of appreciation. Look at how much construction work is happening. I mean, I know I go up and down my street and I'm dodging construction trucks the whole time. And it's people putting money into their houses, which is changing this number on top of appreciation or inflation or whatever you want to call it, right? So this number can be affected by renovations. You know, somebody takes a gut job house and they pour in all this money to it, they could be changing that house from a $250 square foot house to a $500 square foot house, right? So this can reflect, you know, what the renovation money that's going into the houses. So again, this is south of the crosstown. So look at, if you look at percent of original price, the median's 97.7. Again, not 100 like the rest of the market, but definitely improved. Can we look at that? Beginning of 2020, sellers were typically negotiating almost 10%. Right? That's a wow. I mean, that should take you a second, like, wow, that's a 10% negotiation. Now it's down to 2%. So it's definitely improved. But look at back at 12 and 13. If we go back further, look at downtown, people were negotiating at the low. So 2011, people were negotiating almost 18%. Right? So $1 million house was going for 820. So I mean, that's just perspective. And again, go back in time, look at 2006, 2%. Right? So we went from 2% to 18%, back down. And again, this is probably the normal typical range. Now it's interesting, downtown, remember COVID wasn't until right in here, right? Look at pre-COVID. It went from 96 to 91. So this 5% drop is very interesting that happened in 19. I don't think I have answers to that, but this was a very interesting trend prior to COVID that was happening. And then we came out of it and obviously improved. But, you know, obviously people negotiate when there's more supply. So let's look at some of the other one. If you look at the months of supply. So, or homes for, let's go to the homes for sale. And again, I'm doing rolling 12 months. So from 18 to 19, we went up pretty significantly on the supply downtown. Again, I'm not the downtown expert. I don't have the reason why this inventory jumped. But when this inventory jumps like this, what happens? People start to negotiate, right? So this is the opposite reflection of what happened here. Right, and now the inventory went back down. So now we went from 400 for sale to 138. So what happens to the negotiation? It disappears, right? So a lot of these are inversely related, but you know, downtown was a little bit different time frame on when things happened, because prior to COVID, it was going up in inventory and it took a little bit longer to start to drop that inventory. But I mean, that was a pretty significant drop over the past couple of years. Look at the closed sales. You know, so we peaked, and again, this is the rolling 12 months. So this isn't 1 month. So we peaked at 746. We've dropped off to 681, but we came up from 357. So big rise in number of sales. Starting to fall off, depends on how fast that falls off. Now, fortunately, the homes for sale is still kind of a downward trend. So it's still in decent shape from the inventory is not coming back up yet downtown. Here's the new listings. A little slow. So 21% lower than a year ago. So new listings are harder to come by. So there's downtown experiences time lag in this whole crazy market, right? It was like a year to 18 months delayed, and then everything started to happen. And you can see that inventory is still coming down. You know, the prices are still solid. So downtown definitely had a time lag on everything. Here's the pending sales falling off, but that's again a factor of there's just nothing for sale. Dollar volume. So we kind of plateaued in dollar volume the last few months, about 800 million downtown. Shows depending now, they've kind of sat flat around 10. So not a big drop off, but again, I think it's this time lag difference between downtown and the other markets. So, showings per listing at a peak. Look at everything else we looked at, right? Everything's already dropping off in those other areas where downtown time lag seems to be peaking this summer instead of last summer. You can, and again, if we go, let's look at James Island. Again, look at any area that you're doing business, up 14.4%. I mean, I could buy that. I believe that as business. 22 point, and again, I think this is a big reflection on renovation, right? People started renovating their houses and putting money into it and flipping. And I think that's why this is going up faster than the sales price, is that people are taking that same square footage and really making some massive improvements. The median price is still at 100. Average, we're kind of at 100.7, but again, maybe peaking on that. Days on market still really low at 3. What's the supply? 0.6. So again, James Island right now is where Mount Pleasant was at the beginning of the year, right? So you can see, and then part of the point of going through these different markets is that every market's behaving a little bit differently. Right. The overall, when you put the overall numbers, it makes sense, but you've got to look at each market and depending on where you're listing, because James Island is more challenging right now as a buyer than it is Mount Pleasant. Now, again, Mount Pleasant price point's higher, but from an absorption standpoint, we're 0.6 months on James Island. Homes for sale, we're still bottoming out, right? So it's a matter of you have to look at those different markets and see how they're behaving. If we go back, I just wanted to go back to the all real quick. So, and again, I'm going to go back. So that's the max. So here, here's our sales price trend. So from 2012 to right before COVID, that's kind of a good growth. And if you go back to, I think I went back to like 2001, and I mean, we're about 4.8%, which when you look at the entire US over the past, I think it's 50 plus years, we're about 4.7, 4.8%. So that's not atypical, right? And this is obviously not typical. But again, what's wrong with 4 to 5% growth? Really nothing, to be honest. It's probably a healthier market long-term to be in that range. We're changing from, and again, I'm doing a rolling 12 months. We're going to be changing from this double-digit price appreciation, and part of it's interest rates. Now, when we hit, I mean, some people were probably paying 6%. I haven't had any, but I'm sure probably somebody on this call or somebody in our office has had a buyer close at 6%. So, the rates did drop over the last 10 days or so, about a half point. So let's see if you have any buyers out there that maybe can get off the fence based off that, who knows if it's temporary or not. I mean, I think that's all driven by recession fears, and that drop in rates is also probably because the number of mortgage applications dropped, the number of refinances is probably way down. So, all of those are coming into play, that the mortgage industry still drives part of this economy, right? And if it dries up too much, what do? They become more competitive and they lower their rates to acquire more mortgages. So I think that's what that half point drop came from, is just because, stock market, the war, the oil prices, everything was kind of pointing negative. So if you're charging 6% for your mortgage, they weren't getting enough applications. So I think that's what changed part of it. But over the long term, you know, if you look at that, if we go back to this type of trend, that's probably fine, right? And real estate is still, it's important to be a homeowner. I mean, you know, this is a lesson learned for people, you know, especially, you know, younger generations who maybe have never owned a house, and if they got in a house at the right time, you know, they probably couldn't afford it today. I mean, anybody who's a homeowner on this call, look at yourself, and it's like, if you didn't own your house already, could you afford it today? Right? And my answer for my house is no. If I didn't own my house and I was a renter and I tried to buy it today, I couldn't afford it. So it's over the long term, you know, your buyers need to, and again, the timing has to be right for them, but you need to own a home over the long term. And it's a very important conversation to have with your buyers. It's not just, you know, and it's the best way to fight inflation, right? I mean, if we're in this high inflation environment, even if you have a mortgage rate at 5.25%, it's a fixed payment, right? So 5 years from now, if we're experiencing 5 to 6% inflation, your most expensive payment you have at a fixed rate. You know, aside from any insurance changes and taxes, but your biggest payment that you have is at a fixed rate. So it's such an important conversation for your buyers to realize that is a great way to fight inflation. I mean, look at the rental market, right? I mean, rents are up 15, 20% in some areas. So that, is it going to be up another 10 to 12% in a year? I don't know, but it could be, right? But what would your mortgage payment be? It'd be the same. Right. So that's an important conversation when these buyers are trying to decide, they think they're overpaying for a house or the rates are too high. If it's an affordable payment, you know, you're in a fixed position. And if rates down the road, if they go down to 3%, well, then they can refinance. Right. So you're taking away that risk on any upside. But, you know, just the long-term trends, well, you know, the months of supply, and this is a great example, is that we were at 16 months of supply in the recession, right? And we're at 1, you know, in a rolling 12 months, we're at 1. So again, I like the easiest way to look at this. You had 16 sellers back then, one of them would sell that month. Pretty much, if you have a seller, you can sell it that month. And it's such a big difference from here to here. And for those of us that were in the business back here, this was not a fun time to be in the business. Now,
Anton, what do you think about ARMs as far as loans?
I mean, you know, I guess my opinion is, like, if you can get a 7 or 10, if it's the difference between affording a house and not affording a house, then I think it's still a, you know, depending on your buyer, I think it could still be a good financial decision. I'd be worried about 3 or 5 year ARMs, you know, and I know the 7 and 10 year ARMs probably aren't that big of a difference from a 30-year fixed. You know, it's just, they have to be comfortable what the cap is on that payment. Because I mean, if they're doing an ARM and it can go to 8.25, is that going to break them on a payment? You know, I think the best way to look at it is, like, if they get a 3-year ARM, okay, in year 4, if it could be 8.5% and this is your payment, what's that going to do to you? Right? And if it's a freak out moment, then maybe an ARM's not the best place for them. But I also think about, you know, if their option is renting and they have zero control over what the payment's going to be in 3 to 5 years, you know, that's another thing to consider, is that it's still a place of at least having a cap on, you know, your payment. Whereas if you're a tenant, you're kind of at the mercy of the market. You know, I look at some, and this is just kind of me looking at some of the rental complexes around town, like the Jasper downtown. There's 200, I could be wrong, I think there's 221 units. There's 0 on their website available, 0. And those top floor units are $13,000 a month. So, you know, even that type of market, and I looked at the Gill downtown, and I look at the Boulevard in Mount Pleasant, and the rental rates they're charging for these places just seem astronomical to me, but they're filling them. And so, as if unemployment starts to go up, does that start to change the ability for these landlords and these big complexes? Or if there's an overbuilding of multifamily, does that start to tame some of the rental rates? I mean, maybe so, but it's phenomenal what, a little studio in the Boulevard is running, $1,600, $1,700, $1,800. And that's not even having a bedroom. So, and I mean, downtown at the Jasper, it's 2,000 plus for anything. And the Guild downtown, I think that's 2,000 plus. So, you're talking entry price points in some areas being almost $2,000 a month for a rental payment, which you have no tax deductions, no appreciation, no, principal pay down. You have no advantage to that. So, at some point, those people are still buyers. And this is what's happening is that, back in here, when we look at what happened back in here, a lot of people got foreclosed on, short sold. So what do they become? They become a tenant, right? I mean, you had to be. You're either a tenant or you're a homeowner. You're one or the other, right?
Homeless.
And so, right. So what happened in here is when everybody became, they were forced to become a tenant. So what happened is the house prices dropped, but then at some point the rental rates started going up because you had more demand for, for being a tenant, and that drove up the rental prices. So on the backside, as rental prices started to rise and house prices were lower and the interest rates were lower, people started to buy again. So when they started to buy again, the house prices started going up again. And that's all what happened in this cycle here. Now this is, and again, hopefully in my lifetime, this is the most dramatic cycle that we've ever been through. But remember, the lowest we got was 3 months of inventory, right? So I want to put in perspective is like, well, this was a crazy market here, or it felt crazy. This is 3 times as crazy, right? From 3 months of inventory to 1 month, that's 3 times the absorption. So I thought this was crazy until this happened. So this was an extreme low, obviously an extreme high. This is a super extreme low. What happens on the backside? I'd be very skeptical if we got anywhere close to this, mainly because of, fortunately, they did not loosen the lending. This was caused by loose lending mostly, right? And it is, look at your buyers and what they're going through. It is still extremely challenging to get a loan, right? You still, and don't change that. Like, that's great. That's the way it should be, is make it hard to get a loan, because all these people that were buying, they're qualified, they have savings, they have jobs. If they, and the big difference is we're at the highest point of equity percentage in homes in the US ever. And so everybody has so much equity in their homes. If they lost their job, what are they going to do? They're going to go get a second job. And it's still relatively easy to get a job, right? They're going to go borrow money, use their savings. They're not going to skip their house payment, right? Because that is probably, most Americans, that's their biggest asset that they have as an equity. Back here, it was all fake. This happened because everybody was negative equity, right? A vast majority of America was probably upside down. So what did they stop doing? They stopped making a payment on something that they're negative equity on. Here's the exact opposite problem. We have the highest percentage of equity. So if somebody runs into a financial situation, they're still going to do whatever they can to make their house payment. And guess what? If they can't, put a for sale sign in the yard and sell it. They still have so much equity, they can unload it and not become a short sale foreclosure distress type of situation. So that's why I don't see where, because for prices to come down, and again, this is just looking historically, for prices truly to come down, you really have to go up to that 8, 9, 10 months of inventory, right? 6 months of inventory, yeah, I mean, that's kind of where, we were at 4 months here, and we were going up at 4 to 5% on the market. Maybe if you got to 8 months, you might see a little bit of strain on the market, but I think it's kind of minimal price reductions. when you get to 16 months of inventory, you had the price dropping 20 to 30%. But for us to go, so think about it, for us to get back up to 8 months of inventory, that's a long way off still, right? Even if we drop, even if our buyer sales go from 2,000 a month to 1,500 a month, to have 6 months of inventory at 1,500 a month, you still have to have 9,000 houses for sale, right? When is that going to happen? I can't sit here and say that is going to happen. Like 9,000 is a big number from where we're at today at 2,400. And part of what was driven here is the builders were overbuilding, right? And think about the supply chain issues, labor issues these builders are dealing with, right? I mean, I have a house that closed in January. They're still trying to install the microwave. So here we are 6 months later, and the microwave came in and it's the wrong one. So now they have to reorder another one. It's like, well, is that another 6 months? I don't know. So the supply chain issues and labor issues are going to prevent, in my mind, by default, they're preventing builders from being able to overbuild. And they're so far behind on land development. So that new supply of homes is going to be challenged to come on the market. At the same time, and I know we've talked about this before, but think about all those people that bought, look at these closed sales, right? All these closed sales in the past, let's go to 2012, in the past 10 years, where are those people on interest rates? So forget the last 2 months, right? That decade there, who didn't buy or refinance to a rate probably below 4? Most of them probably below 3.5. So this was I think this was when rates were 5%. I read an article that 90% of America had a lower interest rate than 5%. Now we're at 5.5, 5.75 in some cases, so a vast majority of America has an interest rate lower than what you can get today. So what is creating an incentive for an existing homeowner to move? And again, this is near and dear to our hearts as real estate agents. Is like our transaction count is what we have to work on, right? Because that local seller who lives on street B and they want to move 2 streets over, right? They have a disincentive if they have a 2.75% interest rate on their house, right? Well, an alternative to that is, what could you rent it for, right? If you're at 2.75 on a 30-year fixed, well, keep it as an investment. And do you have the down payment and the ability to purchase another house? But everybody who wants to swap houses, that interest rate's going to be huge, preventative decision-making ability, because if they're 2.75 and rates are 5.5, they're doubling their interest payment for an equivalent house. So think about if they're trying to upgrade houses. Think about somebody going from a $500,000 house to $750,000, and they're at 2.75 going to 5.5. I don't even want to do the math on that. That's not something somebody's going to do. So that's why I think your homes for sale, even though we're coming up, and we will be, you're not going to reach. I mean, look, we had 12,000, 11,500, almost 12,000 homes for sale. And again, for if we go down to 1,500 homes for sale and we get to 6 months of inventory, we need 9,000 for sale. Like, when is that going to happen? So now again, like I think the buyers are starting to gain some leverage. You can tell it's not all a seller exclusive driven market at this point. I think that will continue for a period of time, but maybe you had a few people who overpaid for their houses in the spring, got caught up in the moment, but don't look at that as the market as a whole. Just keep watching these numbers, right? This is what really matters. What is the market as a whole? Yeah, I can point out a couple of houses that I'm like, well, I think those buyers probably overpaid for it. But overall, the market is still, and again, the cost of these builders, the labor costs, the supply costs, it's still more expensive. Same thing with car sales, right? I mean, look at used car prices. Look at new car prices. I was reading an article this morning, and the new Tesla truck that's supposed to come out 2023 is when they start to build to start production. they've already have enough orders for the first 3 years of production, and they're not building it till next year. Right? So they've, like, Ford stopped taking orders on their electric vehicles, you know, so there's so much demand out there in all these different facets that the supply chain is still broken from being able to keep up with all this. And as we're finding out, this is not a quick fix. So it's the same thing with the labor. You know, these builders are having, I mean, good luck. I mean, good luck in getting a plumber to come out to your house and fix a minor thing, right? It's like they're so busy that, and it's so expensive, you know, so all of that's going to drive, all of a sudden your new house next month is not 10% cheaper than it is this month. You know, these builders are paying a lot to keep all these houses moving forward, and their carrying costs, you know, it's taking longer to build houses. Everything's more expensive. So they're not all of a sudden going to start, yeah, you'll have some discounts at the end of the quarter and the end of the fiscal year and the same games they've always played. But overall, it's not cheaper for them to build houses. So that's why I'm not, you know, we're in a changing market, but I'm also not thinking we're anywhere close to what we experienced in here. So anybody have any comments, questions, input? All right, well, hope that was a kind of our normal kind of, let's catch up on where the market's at. But again, you got to get your buyers off this fence with the rates that just dropped, and you got to get sellers motivated to put their house in the market, because our challenges as real estate agents right now are it's the transaction count. You know, and you can see, you know, just look at that rolling 12 months of sales, and I'll zoom in a little bit to put perspective, but you know, this is not an upward trend. You know, we peaked out last June and we're here now. This trend isn't changing. It's still headed this way. So you got to fight for those transactions as real estate agents and keep on top of things. So, well, we'll do this again next month, and I hope everybody has a good weekend. And yes.
Sorry, quick question. With the, I think interest rates jumped today. Do you think we're going to have another tick back up now on the mortgage rate side?
I mean, I still think there's, no matter what the Fed does on their adjustments, in the background, these lenders and these banks have to do transactions, right? And I think if the transaction count slows down too much, it's going to slow down any increase and maybe give some discounts at some. I'm not sitting here and saying next week, you know, or next month, we're going to see something with a 4 in front of it.
Right.
But I think the demand has slowed down so much. If it starts with a 6, they're going to run into even bigger problems.
Yeah.
So I think it's still a matter of, they have to be competitive, right? I mean, you have all these different lenders out there, and one who wants to secure more business, they'll undercut the other ones. And I still think they're going to have to, I mean, because we've gone from 3 to 5.5, almost 6 really quickly.
Yes.
Right. And I think we might have gone up fast enough where they need to kind of put a pause on things for a moment on increases. Now, and I'm not saying the Fed, I'm saying the mortgage rates.
Yeah.
You know, I think the mortgage rates priced way ahead of the Fed.
Okay.
Because I mean, think about, what has the Fed done? They haven't gone up 3 points, right? But the mortgage rates have. So I think the mortgage rates priced in a lot of this year's Fed increases. So I think they can't get ahead of themselves much more than they're at right now. Otherwise, because I mean, the refinance demand has got to be almost zero.
Right.
Right. So it's got to be strictly mortgage purchase. And look what's happening to that market, right? The mortgage purchase market is going down. And think about these people with cash, right? I had a lot of buyers when rates were 2.75%. They could have paid cash, but they're like, well, I'm just going to borrow at 2.75. Why would I spend my cash? So I think when rates are 5.5, 6, you're going to have some of those cash buyers who are really going to pay cash instead of borrowing the money.
That's a good point.
So I think your percentage, as this is a weird dynamic, but I think as your number of closings go down, your percentage of closings that might be cash might actually go up. You know, because I mean, why would you not borrow? If you're financially savvy and you have enough money to pay cash for a house, you're probably financially savvy enough to realize, hey, I can borrow at 2.75%, that's tax deductible, and I can invest my money elsewhere. And also think about what's happening in the stock market. People probably that have the cash are probably like, well, who knows what the stock
Right.
market is doing? I know I can pay cash for this house. So
Or
there's
put more
dynamic.
down, or, yeah.
Yeah. So, but you know, from our perspective as real estate agents, it's like, watch this number here, because this is the transaction count is what matters to us at some point, and we're starting to lose some of those transactions. So you really have to be much more diligent at following up with people and getting houses priced right, and having conversations with your buyers. So we're getting into that period where maybe some of the things seemed easy the last couple of years are going to be more challenging. So just be more diligent at your business.
So it seems like we're in a good window to point out to our buyers that with the pullback in rates, maybe you do want to make some decisions.
Yeah, and again, there's nothing telling me, I mean, when you look at the sales price, you know, what's telling me prices are going to come down? You know, I know some of these buyers are like, oh, well, I'll wait for the market to come back down. Well, where's that trend? Like,
Well, again, it's a reduction on a higher price to start with,
right.
right?
And again, like what I wanted to point out is, you know, another thing is that when you look at, and I know we've talked about this before, but the first half of the year is where you see most of your price increases. And the second half of the year is where things flatten out. And I changed it to 6 months for a reason. So if I look at 6 months and I do a rolling 6 months, you can see what happens January to June, and then it just kind of goes flat. And you can see what happens at the beginning of the year, and then it kind of goes flat. In the beginning of the year, and it kind of goes flat. I'm leaving out these years because this is like nothing we've ever experienced. But typically, your run up in price is the first 6 months, and then it's typically flat the next 6 months. So this is another conversation with your buyers, is that the second half of the year, if you can control it, that's when you want to be buying a house. And again, if you're brave enough, buy it over Thanksgiving and Christmas and New Year, right? Because who's doing it then? You have so much less competition then. And that's reflected when, you know, look at your pending sales, right? So I'm going to go back to monthly for this. When do you want to be a buyer? Do you want to be a buyer here when the contracts are going in, or do you want to be a buyer here? You want to be a buyer here, right? So have these conversations with your buyers now. It's July. Say, hey, I'm not saying go buy a house this week for the sake of buying a house, but be diligent and buy a house in the second half of the year, because you're dealing with less competition. And we have an interesting dynamic this year, because there's going to be less competition, because there is every year. Doesn't matter what year it is, right? But the benefit to a buyer right now is you're going to have more inventory the second half of the year too. So you have less competition and more sellers wanting to sell their house. So your buyers should be really focused on buying a house by the fourth quarter. And if the right house comes up tomorrow and the rates are 5.3%, then why not buy it today? But the next 6 months is a prime time for your buyers with more inventory and less competition.
Thank you. Excellent as always.
Well, everybody have a great weekend, and we'll do this again the first Friday of next month.
Thank you, Anton.
Thank you so much, Anton.
Right.
That was great. Thanks.
Bye.
Bye.